Let me ask you about then the acquisition. I mean, if these market conditions are deteriorating, why spend $1.4 billion in another market that looks pretty toppy in the U.S.?
So let me give first highlights on the results. So we have confirmed that Signify will improve its operating margin for the full year, but by 30 to 60 basis points, which is slightly less than what we had originally guided for because of challenging market conditions. Now, when you look at the company in Q3, the part that has to grow is growing by 1%, our growing profit engine, and they're also further improving on the operating margin by 80 basis points. We have connected 3 million light points more, and 78% of what we sell is now LED for another quarter of positive cash flow. You know, we're entering Q4 with 220 million of cash flow. Now, when you do an acquisition, and do an acquisition because of what happens in the quarter or in the semester. You do an acquisition because it is fundamentally strategic for the company. And when you look at Cooper Lighting, it is a clear strategic fit and a substantial value creation deal for us.
Eric, some of the criticism, though, is that it's not necessarily good timing with the US economy cooling off, and also the price might have been a little too high. What would be your response to that?
My response is first that we looked at the industry in general, and when you look at what has happened in the past 4 years, probably 20 to 30% of the corporate assets in the lighting industry have changed hands. We looked at all the opportunities, and we wanted to do that one. And let me explain to you why. So first of all, it is a clear strategic fit for us. The two companies are complementary when it comes to the offers, the go-to-market, and it positions us as the leading lighting company in the biggest and the most progressive market in the world. You know that one of our fundamental strategic objectives is to develop connected lighting, and this is the most progressive market when it comes to connected lighting. So it positions us extremely well in the biggest and fastest growing market when it comes to connectivity. At the end of the day, it is creating a substantial value. Let me give you a few numbers. 60 million that we expect to deliver in terms of synergy in the first 3 years. It's EPS accretive, mid-teens in the first year and mid-20s later. And when we look at the transaction, the ROIC of the transaction will be over our WACC in the first year. So all these elements are conducive to do that deal.
Is this you say you see deteriorating market conditions right now, and you're talking about the outlook for the quarter or the semester, as you just said. What do you see for 2020? I mean, how does the global economy look to Signify?
Look, it's already complicated sometimes to know what's going to happen, 2 or 3 quarters ahead. A year ahead you need a crystal ball. But let me give you the following information. We've been experiencing a slowdown in China in the past quarters. It's not the case in the US at this point in time with the early signs of slowdown, but the economy is still dynamic. But we have slowed down in Europe in the past year, and we had since Q2 to face liquidity tightening in India. India is for us a country in our top 5, so it has had an impact for us. Nevertheless, we have to face the economy that we have in front of us, but we are continuing to innovate. Let me give you the example of the HDMI box for our Hue Philips offer for consumers. You can imagine that you can now plug in that box all your contents, DVDs, movie content, gaming, and the box will synchronize all this content with 10 lights that you may have in your living room, and they will mimic what you have on your screen.